Welcome back to the channel. This video is going to be focused on Target, and I think today's actually presenting us with a good opportunity to get into the stock. And I'm going to explain my thesis as to why. Technically, it's based on an earnings failure. And as you can see on the screen right now, this is the position that I have on. This is a back spread. We're going to speak a little bit about these type of back spreads, why I'm putting them on, and how I select the strike prices in this particular video. Just so you're not confused here, right? This is pretty much like the parent of the position here, and these are the legs here. We sold the 165 calls, we bought the 175 calls, but we're buying double that of the long leg. So this is a bullish position. In our case, we collected a small credit for it. And I just opened this up like less than 10 minutes ago. So hopefully this video will go out as quickly as possible. Let's first look at, let me make myself a little smaller. So they got hit of some controversy in the last 24 hours, which is one of their costumes for Halloween. Not a great look by them. It's obviously being shared all over social media, and this has single-handedly been responsible for their stock dropping today, pretty much 4%. As you could see here. Now, here's the thing. This is an opportunity for us because this is actually an earnings failure trade that I happened to miss. As you can see here on August 19, I mean, not August, October, August 19, correct. August 19, they reported earnings in the morning. They were not great. There was a gap down. Look at this. There was a gap down, and then we built out of the cash session, right? So this was an official earnings failure. Look how well it reversed that day off the back of poor earnings. And it's only gone up ever since then. So even yesterday when I was looking at this stock, I was like, wow, this was quite the miss by me, because it's pretty much gone straight up ever since that earnings failure. But this controversy in the last 24 hours has actually given us the opportunity to possibly get back in here and be relatively close to our stop, because keep in mind, our stop is pretty much going to be here. So again, there's still some distance, right? There's still some distance between us and the stop, but it's way better maybe chasing the position a little bit here than chasing it up there. And it's also one of the reasons as to why I opened up the back spread, is because if we're wrong and this continues to go down, which it can, you never know how badly these controversies can hit a stock. There could be constant public outroar moving forward for the next week or two. We're not going to lose money, right? And we're going to discuss that. Let's visualize the position. So this is how it looks like on the chart. The current price is right here. Okay, so let's just get this out of the way. So purple line represents P&L today. If it were to move, let's say today somehow it moved to 170, we would be up $1,000 in the position. If we go into 180, we would be up 4,000 on the position. Obviously, theta will hurt our trade. As you could see, as I bring the date forward, the purple line slopes in. So this is a trade where we want to see it work. One thing that should stick out to you, though, is if the trade does not work and the stock continues to trade to the downside, we have no loss. We actually have a small gain. If you look at that teal line, it's slightly positive, like $136. Almost let the spread expire. Worthless if you'd like. Personally, I would have recommended, because as you can see, if you go super into the future, you have this max zone here, max loss zone, which can really hurt you. This is an October 16 expiry, by the way. So I just want to show this to you guys. If we go all the way to September 30th, this is what the P&L looks like, right? So this is over a month from now. If we're chilling in this max loss area of 175, we'd be down $1,300 in this position, okay? Not a crazy loss, right? We're not looking at that $7,700 loss position that obviously we would want to super avoid. So again, theta will slowly chip down the P&L here, but still, to really get into this max loss zone, it requires you taking the spread normally into the last week. Other than that, we're giving this trade some time to work out. Obviously, we're betting on a big explosion upward, right? We want to try to get into those 80s, 90s, sometime in September. Obviously, by mid-September, that would be a great time to get it done, right? If we somehow manage to get there by the 14th, as you can see, that's when our P&L starts looking pretty well. we don't want to, obviously, looking at how much I'm risking on this trade, I would not want to lose more than $1,000 on this trade. If we're wrong, obviously, completely, we're pretty much losing nothing. I could take this trade off for just commissions. And if I wait long enough to be in this trade here, we're in September here, and price is still chilling down here, the chances of it going any higher, it's not going to happen at that point in time to go all the way up here. So in this case, same thing. I'm taking this trade off for like $700, But if we're correct, and this is the start of something big for Target, a big recovery, okay, we might make, $5, 6, 7, $8,000. That's kind of how the split looks like over there. Now, why did I choose to go with the back spread? Well, for starters, we have no clue how bad the controversy is going to hit the stock, so we have the downside protected. Second of all, I look at the implied volatility percentage. Kind of tells me where the current implied volatility falls within the 52-week range. Normally for Target, it's on the lower side. It's at 20%. So we know that we're not overpaying, let's say, for options. I don't want to use overpaying, but the point being is that there's not that much volatility baked into these options as it normally would be. It's below average. Second of all, I make sure that I have implied volatility selected by the strikes here. And when I'm looking at this, our goal is to try to sell the strike that has the higher vol and buy the strike that has the lower volatility. Very often, the volatilities that you see here are very much affected by what's being bought and what's being sold, right? So you can see there are very small differences between some strikes over the others, and it does give us some input. Now, obviously, how wide the spreads will also be affect the volatility that seemingly is baked into it. But so when I selected the 165 and 175, just take a look at this here, right? So the 165s are going for 31 its implied volatility is 31.65 as I'm talking to you guys right now, and this leg was at 31.49. Well, notice that as I'm having this conversation with you guys, it's changing a lot back and forth. And that's going to be the case as orders are being put through and as the spreads also widen and tighten. When I put this on, even though I no longer have it locked in, the 165 was about something like 30 to 40 basis points higher than the 175. Now, normally speaking, I just want to make sure that the leg that I'm buying is not considerably more expensive than the leg that I'm selling. Okay, I'm not necessarily trying to arbitrage or make any advantage over the fact that the one that I'm buying is considerably lower. I just want to make sure I'm not overpaying for volatility and that strike price, right? You might sometimes get a situation where the one you're buying is like, let's say the one I was buying was at, instead of it being 31, 34, it was like 33, 34 or something, right? So it's like 2 whole points above. That's what I want to avoid, okay? I want to avoid overpaying for volatility for a specific strike price. If I can get it below the one I'm selling, that's great. That gives me more cushion that as I'm trying to put the order through and I might have to move the midpoint around and so forth, I know that I'm not overpaying for the leg that I'm getting in. As we have this conversation, you can see that both of those legs are pretty similar to one another. The 170 leg actually is about 50 basis points higher right now than the 165. So again, these are going to move back and forth. In general, though, if you were to chart out the implied volatility across these strikes, the smile would be pretty flat. So I actually wouldn't be too worried about what strike prices you choose here because it's pretty flat. Sometimes you get situations where as you move further out of the money, the implied volatility on those legs shoot up like crazy because you have retail chasing the stock and trying to bid up like the deltas like 30s and paying like crazy for those, and that's increasing the implied volatility on those legs. So you have to just watch out for that. What would the curve look like, looking at this here? And as an example, you could look at this at TOS. So this is on TOS's platform. If you go to product depth, I made sure to select the calls, let's say, the expiration I cared about. So notice that when we look at the smile here, as we move further out of the money, right? Because MSTR right now is trading at, what is it trading? 123. So this is pretty much where we're trading. As we move out of the money, notice how the implied volatility on the strikes continues to go up. So you're overpaying, right, for volatility in those situations. That's strictly coming from the fact that there's so much demand for these calls here, and that's pushing up the call price. So opening up a back spread is not great here, right? Because you're pretty much, imagine this situation here. You're selling a 125 strike that's trading at a 76 vol, and then you're trying to, let's say, buy the 140s that are at 78 vol. You see the difference there? Like, that's not what we want to be doing. We want to be buying and selling on a relatively flat vol surface, right? So even something around this zone here, like the 150, yeah, the 115 to 125, like, okay, a back spread, you know, we could maybe imagine that there, right? But we can't be pushing all the way out here. So just ingrain this in your head, how this slope currently looks like. And then let's go back to target. And I'll show to you guys how I have this set up. So if we go back to target here, this is targets. Look at how much of a difference it is, right? If we look out of the money again, so target is at 163 right here. Notice that as we look out of the money, it's flat, right? We didn't even have to chart this. That's why when I was kind of looking at those numbers, you can just easily visualize the fact that it's going to be flat, right? And it is flat. Look at this. It's even sloping downwards here in the 185s, let's say, right? Like this is a good spot to be doing a back spread, especially when the IV percentile is also on the low side, right? So we have two things working for us. IV percentile is on the low side, plus the smile is also going to be flat. That's what we want to see. And that's the position I have on. So this is what I have on. Again, no guarantee that the trade is going to work out, but it's a trade that is set up in a way that's going to mitigate our losses if we are wrong, and that's the name of the game. And if we go back to my position, this is what it is right now. It's pretty much flat, down $27. Keep in mind, that actually does bake in the commissions I paid for this. So that's how Interactive Brokers sets it up. Now, with all that being said, if this video is helpful, leave me a like, subscribe for more content such as this one. Other than that, thank you so much for watching. Till next time.